Hi, everyone. Welcome to Topline, episode 76. We've been on a roll. We've had all-time highs in terms of a lot of different things, and one of them is our enjoyment of talking to each other. Last week, we gave ourselves a 10 out of 10. The week before that, we'd also given ourselves a 10 out of 10. I'm excited for it. I hope you're excited. I'm Sam Jacobs. I'm joined by my co-hosts, Asad Zaman and AJ Bruno. Welcome to episode 76. AJ, nice hat. Are you in Boston as well?
Yeah, you said we're gonna this week we're gonna do great things, but I'm in a hotel room, and we all know what that means when I'm in a hotel room. You know,
hotel room.
that means that my internet, Sam, is gonna be
My
spotty.
internet. I was trying to dial in here, and it was just like, anyway. I don't think this is going to go well, but I'm not.
Welcome to Topline, the podcast for the best founders, operators, and investors in B2B tech. Every week, AJ Bruno, Asad Zaman, and me, Sam Jacobs, will break down what's important for you to know to be the most well-informed professionals in the market.
What do the revenue leaders at Google, 3M, IBM, Shopify, Square, and Cisco have in common? Their teams all use SalesLoft to hit their number. SalesLoft is the only platform that's designed for the way revenue teams work every day, so sellers can prioritize and take the right actions to get more deals done, from prospecting and deal management to coaching and forecasting. No more guesswork, no more wasted time on non-selling activities. Follow SalesLoft on LinkedIn to learn more.
After 10 out of 10. Yeah, it's going to be a 10 out of 10 in terms of our enjoyment. That's
we're going to love it. Don't know about you.
Framework. It's a framework.
We were talking about frameworks right before this episode started, so we might.
When is it a framework? It's a fine line between a framework and a list.
Very fine line for a lot of people.
But never a playbook. Can't be playbooks. No, it's always a framework.
That has a very rigid criteria and a research note. That's not a framework.
Research notes.
Austin, how are you?
I'm good. I'm back. I'm recharged. You guys saw me at the end of my rope last week, and then I took a couple of days to rest and recharge. Now I'm back. I feel good.
Well, if you haven't listened to the last two episodes, Asad's been on a tear.
It's been a spicy.
Last week, Asad lambasted the role of RevOps. He said there's no place for it.
Yeah.
He said if you're a RevOps professional, you can go straight to hell.
I was strangely pessimistic and probably a little bit unfair to them.
He defecated on the grave of our most estimable RevOps hero, JS Forecast. And then the week before that, he had a very tense interaction with Mark Cosoglo, the founder of Operator AI. I've gotten multiple pieces of feedback from that. People are like, that was good content, but Asad was grilling that guy.
I've heard the same thing.
Well, I'm also a huge fan of founder mode. Don't forget about that one, Sam. He was all about founder mode multiple times over.
I gave everything on these two episodes. I needed a couple of days to rest and recharge.
Well, I think maybe you don't need to rest and recharge because maybe that was your all-time peak performance.
But Austin, I have a real question for you. Was it a silent retreat? Did you go on a silent retreat? No.
I went on the opposite of silent retreat. On Wednesday, I went to a restaurant and I was like, we booked a table. And you know how when you go two people, they put you on these little tables where like you're literally sitting on top of somebody else. I was like, guys, I can't do this. You see that big table for 8 people? I want that one. I'm going to order your entire menu, but I want to sit there. And then I sat there and I feasted and it was a great time. I laughed loudly. The whole restaurant was staring. It was great. It was fantastic.
That's wonderful. I like that, actually.
Gregarious.
Well, anytime Asad travels, he wants the best. If you can't tell, Asad has a little bit of a, I won't call it bougie, because you have just expectations that when you travel.
Yeah, taste.
Exactly.
Yeah. Stylish guy.
Is it still 9-1 in cornhole, AJ, between you and Ange?
No, I beat her twice on Saturday. I finally figured out the trick to cornhole.
Which is shoving your opponent into the pool,
running away.
You aim for the hole. Actually, it turns out there's a real easy way, an easy method of cornhole. I won twice, and I've been practicing against my daughters. So I just at like 9 p.m. when Ange goes upstairs, I'm just like, Nora, let's go play cornhole so I can beat your mother. And she's okay. She says okay. So the score is now 13-3 for anyone that's counting. By the way.
Okay, so Ange has expanded her lead despite
weird. But the summer's over, so we start.
It was 9-1 last week, and now it's 13-3. She was up by 8 last week. Now she's up by 10.
Who's counting, Sam? Who's counting the scoreboard is. Oh man, yeah. It's summer's almost over though, so we're gonna reset on the scoreboard, and the summer is almost. Guys, we have like 4 days of summer left.
Summer comes and goes very quickly. It's best not to focus on summers, in my experience.
Well, fall's here though. You guys.
Fall's the best season. Summer's the second worst season. Besides,
summer is the second worst season for you.
I don't know. I don't like seasons where it's just an excuse for people not to work.
Yeah, summer has a little bit of those vibes. It's a lot of long weekends.
Let's all be creating stuff together. Let's put our best foot forward. Let's buckle our chin straps and strap on our helmets and put our pads on and go to work.
Let's go. I love how last week it was RevOps versus like sales leadership. This week, tune in for summer versus fall.
Fall's gonna win every time. Fall's undefeated. All right, Asad, what are we talking about?
We have some really fun things to talk about, but we're going to start with go-to-market efficiency. So a couple of months ago, a friend of the pod, David Spitz, introduced this new KPI called Sales and Market Efficiency. And since then, he's partnered with Jarko and the rest of the Winning by Design team to publish a paper on this topic. And they call it Go-to-Market Efficiency now. And the paper is called How Go-to-Market Efficiency Affects IPO Readiness. Go-to-market efficiency, what is it? Well, it's basically a KPI that's measured by looking at the last 12 months of your sales and marketing spend, dividing it by the net new ARR that you generated in the last 12 months, and multiplying that by 100. And what are you looking for? You're looking for a factor of 1 or 100%, which basically means that it costs you $1 to generate $1 of net new ARR, which is good. So then they said, let's go look at a bunch of companies and see how they're doing. And so they looked at 72 publicly traded tech companies, and they found the following. 57% of these companies were paying more than $2 per dollar of net new ARR. 31 of these 72 companies, this trend was worsening quarter over quarter. But 10 of these companies actually had a go-to-market efficiency of less than 100%, meaning they were spending less than $1 per dollar of net new ARR. They have a proposed solution, which is treat go-to-market as a lean revenue factory, which basically means that instead of just focusing on throughput or growth, you focus on optimizing processes. We're not litigating the proposed solution per se, but people should go and read the paper. It's also a really good example of content marketing. And for the marketers on this call, a really interesting click funnel that Winning by Design uses, which is the paper, LinkedIn post, free workshop, goes to a paid workshop, goes to a larger engagement. Now, what we're going to discuss is this a good metric? How important is it, etc.? So the question I have is that a number of lagging indicators tell the story of the last couple of years. You can look at CAC payback. You can look at retention, growth, free cash flow margin, etc. And I think this metric does a good job of telling the story. The question is, how does it help you make decisions about the future? Because in business, all of us have to look out and make a call. And we need to then deploy capital to actualize what we think is possible. And those investments we make well in advance, and they're heavy investments like hiring a bunch of salespeople and ramping them up and investing in demand generation. And the thing I was thinking about is all these companies that had a go-to-market efficiency of 4 or 5 or 6 or 7, they didn't want that. They didn't set out for that. They wanted to be efficient, but they made the wrong call on what was possible, or they executed badly against what was possible, or a combination of the two. And so would them have been knowing that 2022 go-to-market efficiency have helped them avoid this outcome becomes the question. So how do you think about this, Sam? You read the paper. Do you think this metric helps you avoid the type of things that happen to these companies that are performing badly against this metric?
I found the paper incomplete.
Did Paul Graham write it?
They looked at 5 quarters. If you look at the graphs that they presented, it really isn't very much time. They mentioned that there's a GTM deterioration if it's over 6 quarters, a significant worsening. But I think to your point, Asad, there's so many they didn't establish any explanatory cause. So they said these companies are getting worse. And really, by getting worse, if you look at the graphs in the paper, they meant they got worse on a year-over-year basis.
Yeah.
Because I think I only saw, they say 6 quarters, but I looked at 5 quarters. Maybe there's 6 quarters. You're a public company, you're making investments over the course of 2, 3, 4-year time horizons. I don't think that looking at 4, 5, 6 quarters is sufficiently explanatory to tell us really what's going on. There's a lot of things that could happen that could significantly change GTM efficiency. The implication of the article is that the companies that have deteriorating GTM efficiency do so because they don't have the right operational model in place to understand how to make proper investments. But then you look at, well, what specific investments or how should you improve your go-to-market execution? And again, I found it a little incomplete. But I can explain, what I read. So that's sort of my first reaction is things can change pretty wildly. If you have a fixed cost, which is the existing size of your sales force, but you have different performance for a bunch of different reasons on an annual basis this year relative to last year, your GTM efficiency can swing wildly, and it's not particularly explanatory. Now, why is it a good metric? It's a good metric because it references net new ARR, not just total new ARR. Yeah. So it's not just a comparison of sales and marketing investment to new ARR acquisition. It's really a comparison of sales and marketing investment to overall revenue growth, which means it includes retention and it includes some eye towards the bow tie, which is Jocko's point, which is, you can't really have a go-to-market motion or a go-to-market methodology that doesn't explain ongoing customer impact and customer retention, because that's ultimately the thing that's going to drive up the growth of an organization. So I like it because it includes retention and it references effectively LTV. I don't like it because it doesn't provide for me a lot of explanatory help. The purpose of the lean manufacturing methodology, which it then goes to explain, is that you can break out this entire bow tie idea into stage-based conversion funnels, and you can look at specific activities that might increase or decrease your conversion rate. And that's his point about treating it like a factory. You have to be scientific about how do we improve? What's the conversion rate from discovery to negotiation? What's the conversion rate from negotiation to close one? What's the conversion rate from close one to onboarding or adoption, or to onboarding? What is your conversion rate from onboarding to adoption? What is your conversion rate from adoption to ongoing renewal, or whatever it may be? And if you look at those and break them apart, then there's an opportunity to more deeply understand them. That's, I think, a good thing. But then it still, for me, wasn't explanatory enough. What exactly should you do? So I texted Jocko before we got on the podcast, and I said, okay, in your experience, I want to look at it like a machine. I want to break apart the conversion funnel. What's the easiest, best thing you've seen to do in order to improve go-to-market efficiency and drive up, your overall net ARR growth? And I found his answer. I love him. And he called me, and I didn't answer because I was in a meeting. But he said, stop discounting. And I just did not find that to be a very compelling answer. I felt like, I think there's a lot of
there's a lot of spend that is not discounting compared to headcount spend. I think headcount is what gets you into trouble. I just
think discounting, there's so much noise. Everybody complains about discounting, but I don't know. I assume that people are discounting for a reason. His point is you can teach the salespeople to stop discounting and you can immediately, so maybe that's true. And I'll hit that back to the both of you. So those are all of my, how do I summarize my takeaway? I think it's really interesting. I like it because it includes retention, which is really the driver of long-term enterprise value. I don't find it particularly explanatory, to your point, Asad. It doesn't help you make specific investments decisions unless you look at GTM efficiency by channel potentially, which could be particularly interesting. And I like the idea of breaking things out into discrete stages and then looking at opportunities to improve conversion rates through those stages. But my experience is that it's never as easy as it appears on the surface. And when you want to improve win rate, you decrease leads. and oftentimes you make the same amount of money. You want to improve your leads, you decrease win rate, and oftentimes you make the same amount of money. And so I think implementing the logical implications of this model so that you can drive better business performance does not seem as obvious to me as the paper would imply. AJ, what do you think?
Well, complaining about reps discounting is like owning a zoo and complaining about animal shit. Like, it's just going to be a way
That's
of
a
life.
good metaphor.
Yeah,
It's just a way of life for sales teams. It's a part of the thing. So I think the incompleteness is interesting, but look, I read the paper. It's 20 pages long, and I was kind of surprised to still also be left wanting to just understand it better. Understand from Spitz's side, like, that dollar for dollar that you talked about, Austin. Where does that number come from? I didn't. Why is that looked at as the benchmark of like that's like what it looks like? I've always thought of you're going to put in X number of dollars and you're not going to get a full dollar back on that original acquisition channel. Like that's not the thing. I also liked how you said litigating these topics. It's almost like we've come up with these terms. I'm just imagining the three of us in court with arguing and litigating TCAC or PEG or GAC, and we're talking about all of these things. Here we are.
It's kind of important, right? Because I think what was really missing before Topline was there was a lot of tactical content, but there wasn't a lot of this. Like, is this a good idea? What's the good in this, and what's the bad in this, and what does this like? I think that was missing, which has been fun to bring into the equation.
Yeah, but overall, my take on it is that I appreciate anyone that's looking at these go-to-market metrics differently in today's world. But also what fails for me is comparing it to that time horizon and like really just we're just shooting darts in the dark a little bit and a little bit unknown and seeing what sticks. So my question then is like, okay, cool, this is great, this lean revenue production is, but who's taking that and actually saying we're no longer doing challenger sales methodology. We're doing this methodology. Is that something that are going to like teams out there are supposed to take this winning by design framework and run with it? I mean,
winning by design's sales methodology is spiced, right? Which is so they've
got
part
of the bow tie, correct?
They've got an operational structure, which is this thing. The lean revenue factory is kind of how you think about the machine and how it's structured. And then in terms of like the people within that machine, the way that they talk to their customers, the way that they qualify the customers, etc., that is spiced, which competes with challenger.
Can you explain spice for people out there that might not be familiar with it?
I don't know it in and out, to be honest. Like, I don't know the in and outs of it, but very quickly, yeah, it's like...
I'm just shaking his head, which is funny.
Don't ask me. Don't ask me.
I think...
We're deep partners with Winning by Design. Do not ask me what spice is.
One thing that I do appreciate about how Jocko thinks about the sales methodology is that he says that a sales team should be trained to be mixed martial artists versus to be focused on one type of methodology. So you should take the best of many and then adjust based on the situation. So an example he gives is that if you are in a competitive deal and the client has budget, they're going to buy something, and they're now looking at you versus a competitor, it does behoove you to go into solution selling in that moment and talk about how the particular solution you've got, a particular feature that you've got, outperforms the other company if that feature is important to them. Like, you have to be able to shift to that. And so that's how he thinks about this. But the lean revenue factory is more the operational model. I found my 2 cents. I think it's really hard to make calls on the future. When you think about stock picking, look at hedge funds, look at financial planners, and look at their performance against the S&P 500. Rarely do they beat the S&P 500, which is why they say don't look for a needle in a haystack, just buy the haystack, buy an index fund, right, that tracks the S&P 500. And so it's really hard to make calls on the future. And in business, we have to. In business, we have to today look out into the future, look at our business, how it's been doing, the market, and then find this intersection point of what we think is possible. And these are bets. They really are bets, and they're really hard to make. They're easier to make when things are stable and everything's improving, because you'll still do well. Maybe you got it wrong as to how well you'll do. But it really comes to light when the market's more volatile and it's challenging like it was in 2023. And so to me, the question became that, well, if in 2022 I knew my go-to-market efficiency, would I have had a different 2023? And I don't know. I don't know, because a lot of those investments, Sam, as you said, had already been made or would be made. And then you see how the market plays out, and the market might get worse towards the second half of the year than at the front end of the year. And I think people underappreciate what a significant percent of your go-to-market costs are headcount. I think it's like 40% of the cost, or 30 to 40% of the cost. So you're hiring people,
cost to go to market.
Yeah, your go-to-market costs.
I mean, the overall cost for headcount cost of a SaaS business is 80%. I mean, that's it's a huge cost.
We're talking about people investments here then, right? It's not about discounting. It's not about the tech stack. It's not all of these things. It's like, I need to hire X amount of people based on what I think is possible. And this is why I think it's possible. This is my hypothesis. And if it plays out, you look good. And if it doesn't play out, you look bad. But I think sometimes the insinuation becomes, and I'm not saying they insinuated this, but readers of this, they insinuate like they're a bunch of crazy companies that wanted a 5x because they're still in the growth at all cost mode. And that's bananas. There's no one sitting trying to think like that in a publicly traded company.
Well, we looked at I looked at our own efficiency, go-to-market efficiency, after David Spitz had that post about it, because I was just kind of curious and I wanted to see where we compared against the public market. So we're at 240%. It's come down substantially over the last year.
So for the folks out there, what that's supposed to mean is that for every new dollar of ARR AJ gets, he spends $2.40.
Yeah, 40 cents, correct. And at worst,
which is another way. Sorry to interrupt, but I was almost going to say it was another way of looking at payback period, but it's not payback period because this is net ARR growth. So this includes retention. It's not just new ARR. Yeah. Anyway, go ahead.
Yeah. And I mean, our retention, I guess one question is, does it include expansion? I mean, I guess through that number it does. Through the net, it's going to include the expansion number. So our GRR numbers have gotten better over time. But we're still in venture growth mode, and we're going to grow as a venture company. We'll grow in 2024, and we're having a great year, as we've talked about. And it's come down by a factor of like 3x. And I think that that's a really interesting metric. Now, is it a metric that I can literally share at the board meeting for my board to understand what it actually means? I'm not sure. I'm not sure it's commonplace that they would look at that and be like, okay, what is this? They don't have any pattern. They're not going to pattern match that against their other companies because their other companies aren't going to share it, right? So,
and AJ, did it tell you something that you didn't already know? Like, that becomes the question, because right now we're talking about lagging indicators, and a lot of the conversation is lagging versus leading. So, but let's just click in. Like, we've already got a set of lagging indicators. When you compare this to them, did this tell you something where you're like, ooh, interesting? Or was it just like, oh yeah, okay, I kind of knew this?
It made me want to dig in further, which I think was the point of the metric in the first place. It made me want to actually take another look at it and better understand, what is this supposed to tell me, and understand the trend and where in
what do you think it's supposed to tell you? This is, I think, the whole point of what we're talking about, which is like, what are we supposed
to do with this?
What are we supposed to do with this? Because what I would do with it, to your point, is double click. Like, for me, the benefit of this metric is its simplicity. But then my first reaction is, well, let me dissect the metric to understand the component parts, and let me eliminate the simplicity of it to try to understand what's driving it. In my guess, again, it's net ARR growth. So what's going to drive it? New acquisition and retention. Yeah. And so now we're back to LTV to CAC, right? Which is the point of like, are we acquiring good business that sticks around, or are we burning through and leaving money out the tail end in the exhaust pipe? And then the answer is fixed retention. It seems to me that the answer to all of this, every metric in recurring revenue businesses, is fixed retention.
Fixed retention.
Fixed retention. 100%. And also on the other side of it, it already told me what I knew. So it hit my selection bias, but my dollar per FTE on the sales side is at an all-time high. And I know that trend's going up and to the right, and our GRs is getting better. So this chart that David Spitz has is going down to the left. It's getting more efficient. Can we get it to 100%? I don't think we should. And the answer is probably no. Now, our NRR needs to be wildly higher. Our net revenue retention needs to be wildly higher than 100%. And I think for businesses that have had NRR higher than 100%, I'm sure this number is pretty efficient on the public market.
Probably.
I don't know if they had the specific call outs or if David had like a snowflake on
I think
it.
he made a post at some point about it. Listen, there are a lot of correlations that he's shown, which I think have been great. That, okay, if you have an efficient spend on efficient go-to-market spend, then your valuation is better, your NRR is better, like you're just performing better, which kind of made sense, right? But it's correlation. And I think what we are talking about is, well, once you get the correlation, then you click in to find what's the causation. And the causation are the things that Sam spoke about, but they themselves still don't tell you what's possible in the future. And I think we have to give CROs and CFOs and CEOs their due that this is really hard. You calling the future is hard. And you can, I think what's better off, like there's an intersection of lagging indicators, leading indicators, and market understanding that enables you to make a call. And still, if the best hedge funds find it difficult to beat the market, it's let's give these CEOs, CROs, CFOs their due that they're doing something really, really difficult, and in volatile times, they'll most likely have these type of metrics. The other argument is that if you had an inefficient spend, well, what can you do? You can either make it more efficient by driving more momentum, or you can cut costs even more aggressively. But if you're a publicly traded company and you go on the back foot that aggressively, what's going to happen? Like, you don't get decimated. So you're also threading this needle in the public markets of saying, okay, if I go this pessimistic to the public markets, I won't even be in the S&P 500 anymore. And so let me try to go for this. I think this is possible. We'll give it our best shot. Maybe things will work out in our favor. And you kind of go for this middle ground between overly optimistic and overly pessimistic, because I don't think overly pessimistic tech companies are given a lot of favor in the public market. So it's also like you have to give them some empathy for the needle they're trying to thread.
So it's the do better framework.
There's a distinct tension between growth and efficiency. That's part of their point. We're out of a growth at any cost world. We need to move to a more efficient, a profitable, efficient growth world, a PEG world. The point, I don't know if it's all of the point, but one point is that efficiency and growth are inversely correlated. The more efficient you need to be, the more careful you need to be. So one of the ways to improve your GTM efficiency, to the point, is to move much slower so that you can be more precise in your investments. And they talk in the paper about framing out different possible go-to-market investments, and then on a small scale. And the specific example I believe they use is around whether they should move from a totally unassisted self-sign-up PLG motion to one where there's this video that sort of like a self-assisted demo. And they talk about the process which you might go to improve the conversion rate on your self-sign-up on your website. And the point is that all of this takes a long time, because you might make a change and then monitor it for 3 months, and then make another change and monitor it for another 3 months. And you might not be ready to make a formal change in terms of how you interact with the market on a large scale for 6, 9, 12 months, which also makes it strange that, again, the time horizon for the paper itself is just 6 quarters. And I believe it's from Q1 2023. And so they're talking about these companies that have become inefficient without also acknowledging that these inefficiencies are really going to swing pretty wildly and not be representative. And you need to smooth them out, probably not over 6 quarters, but probably over 12, 14, 15, 16 quarters. My experience in general is, the key lesson, or one key lesson I've learned over the last couple of years as a CEO, is that doing things the right way takes time, and it takes way more time than we've been led to believe by literature from folks like Reid Hoffman about scaling and about triple, twice, double, 3 times. And all of those metrics and methodologies were predicated on extremely low interest rates and extremely high growth expectations. And there's going to definitionally be a tremendous amount of waste when you do those things. I think that's part of their point. Part of their point is you can't be inefficient and grow super quickly. So everybody's got to ratchet down their growth expectations if they're going to be intentional about how they deploy capital.
Yeah, if you're profitable, then yes, 100%. But if you're venture backed as a business and you have a Series B, a Series C board, then what? Then you're having to like slowly move the needle and balance the both. You're like, well, we're growing at 60%, 70%, and we're not burning this much, and we have a lot of balance sheet and capital, so we're doing all of the things. Is that the answer until we can return to normal interest rates, if that's ever a thing? Because what if you don't have 12 quarters? Like 12 quarters is a long time for venture-backed companies. That doesn't seem
I know.
reasonable for a company that's like, we have 12 to 24 months of runway. What are we telling them?
Yeah, and then on the
I
flip
don't know. What you tell me? What do you tell them?
side,
Get your burn down.
that's why I think burn multiple is a really interesting metric, right? Like burn multiple, I think can be used at a much earlier stage, which is like your overall capital deployment against your overall business performance. I think like David Spitz was sharp in coming up with that. I think that's a really good metric.
Yeah, because that's burn multiple speaks to investability. That's the point. Like if you're going to run out of money, then you got to be showing that you're growing really, really quickly. Therefore, you are investable. GTM efficiency doesn't. Again, it's just not very prescriptive.
Because you can also argue, like there might be a company that says, we're going to run a go-to-market team that is inefficient, but all our developers are in Brazil and India and Pakistan. And so our engineering and product costs are much lower than standard for a company of our sort. We can make it work. One of our founders is from there, this and that. Like we can make this work. So our average cost compared to the average company of our sort is much lower here. And so we can take it much higher there. So if you saw their burn multiple, it might just be good. But if you saw one function in a vacuum, you'd be like so good if you looked at product and engineering. You'd be like so bad if you looked at sales and marketing. And I think if you look at a company more holistically, it gives you a little bit better of an idea that are they deploying capital at a holistic level intelligently? I think that's really important. I think the second thing is understanding that there are not a lot of, I think sometimes and I might do this sometimes as well, like paint with broad brushes. Like there's just a lot of everyone everywhere is being crazy and incompetent. And it's like, man, these publicly traded companies, a lot of them are run by really sharp people. They have models. They are being thoughtful. They are being, they want to run their businesses well. There's no publicly traded company that doesn't have an operating model and go to market. It might not be the best one, might not be run the best way, but they have it. These are good people trying to do good work, and they're very thoughtful. That's how they got there. And they know how to balance a number of priorities, including how analysts are going to view them in the market, not in a vacuum, but in the market. And I think some of the companies that had go-to-market efficiency that wasn't all that great, look at their stock performance. They might argue that we got through this period better than we would have if we took your advice and slashed everything down. Because 6 months ago, Jotto released a paper where he said, shut product lines, fire your executive team. It's going to be a disaster. If those companies did that, they wouldn't be in the indexes anymore. And so, I don't know.
Hi. Are you coming to Austin for GTM 2024, October 14th through 16th this year? If so, I look forward to seeing you there. My name is John Montague with Executive Focus, and I'll be diving into a working session where we're going to talk about how to leverage your network, communities that you participate in, like Pavilion and others, in your job search strategy. Let's face it, we're in a tough job market, and it doesn't matter in any market, looking for a job, well, to use a technical term, sucks. So what are the tools, the strategies, the hacks that you can use to nail your job search in 2024 and 2025? Cover this session, we'll be diving into it and help you out. Oh, by the way, when you go to get your ticket, go to www.joinpavilion.com/GTM 2024. And as a quick inside hack, as a Topline listener, add into the discount code Topline for an additional 15% off. I hope to see you in Austin. I look forward to it. Thanks.
I have a question related to this, because even just looking at the left side of the bow tie, which is the pre-sale funnel, I find and I'm curious, AJ, your experience on this as a commercial leader and as somebody that's, probably has a high volume of inbound leads that you're trying to convert. The point I made earlier is that my experience is that some people, RevOps people, the bane of our existence, they look at, just kidding, we love you, RevOps.
My enemies.
They look at a funnel and they say, if I can take win rate from 15 to 20% or 20 to 25%, then I can change the entire dynamic of the commercial model. And my experience is that there's no free lunch, and that most of the way that you do that is by tightening your focus on your ICP. Easiest way to drive up win rate, besides magically making all the sales team better, and that's another thing that I haven't really seen happen. Maybe it's possible. I want to hear from the great leaders, the great commercial leaders in feedback. You can post on LinkedIn, or you can touch base with us in the Topline Slack channel. But what I'm trying to understand is, and again, getting to the point, my experience is that you drive up win rate by tightening your ICP, and you drive down lead flow. And if you want to drive up lead flow, you're going to drive down win rate. And that most of the time, the incremental improvement is exactly that. It's not incremental. That most of the time, there's no massive unlock through the conversion funnel that if you just change one thing, all of a sudden you're making 50% more money. But that's been my experience. AJ, have you had a different experience?
This is the crux of every founder and operator. It's both taking what the mental model and what the market is going to look like, and also reconciling that with knowing your business. You have to know your customer. You have to know the types of customers that you've brought on previously, and you have to know where the market is headed. You're hitting on something that I know I'm dealing with. I know every founder in a SaaS business, is CEO, operator, is dealing with this right now. We have these bunch of customers that we've taken on, we've onboarded them, we've gone through the whole process. They are a cohort. We've learned from them, but they're not the right customer. Do we fire them and rip the Band-Aid off and say, like, we're a $10 million business, 7 million of it is healthy, 3 million of it is not. We are spending way too much time on $3 million of it. We are servicing them. We're having to do integrations. We're doing all of these things. They are not the right customer. This is the right customer. We are no longer going to assign dedicated AMs. We're no longer even going to do one-to-many in CS. We're no longer, when they come inbound, they can go through our self-serve, PLG, whatever funnel, but we're not going to do anything with them. This is actually like legitimately something that I see firsthand in my own business, and I see in others' businesses.
Interesting.
And here's a really challenging part for you, Sam. Let's say Quota Path's like, we're moving in mid-market. We saw Salesforce buy Spiff. It leaves a huge opportunity. We're going to the head of it. But wait a second, HubSpot and their ideal customer profile is down market and SMB. A lot of our tailwinds come from the strategic partnership that we've created with them, but they're not always the right type of customer. But our demand is coming in massively from them. It's causing us to hit 150% of our growth plan, but we don't know if they're going to be able to retain them because the product pieces of it aren't supporting it in the right way. What do you do? How do you think about that? It's both the magical. It's a magical time to be a CEO founder because you get to go solve that really challenging problem.
It's such an interesting problem, right?
It is. It's true. I haven't
Here's
used
one
it in a
angle
while.
for it. We went through this recently, and so here's how we thought about one similar type of situation. So we had a partner that was giving us, that we thought there was a lot of opportunity with. But initially, the stuff that was coming through that partner wasn't the highest of quality. And we thought, well, if we can do this, we're going to earn trust over the next 6 months by kind of just being their firefighters. If they call us and there's an emergency, we don't give it our best shot. We don't fix the problem for them. It's not going to be the most profitable business for us. It's not the stuff we want to see ourselves doing over the long term. But if we can do this, then does that trust unlock the next tier of opportunities? And so we're willing to deal with this pain because there's this future upside. You could also think of it as, if you're trying to get into a new vertical, you might not be able to go to if you want to sell mid-market, you might not be able to enter that vertical mid-market. You might want to enter that vertical SMB for 6 months and get some wins, understand how they think, understand the market a bit more, and then start moving up market. Who does that if you have a small TAM? So let's say you don't have thousands of companies to go after. So you have constrained TAM. So you really want to sharpen your spear before you go after this constrained TAM. You'll do this SMB is small, medium-sized businesses.
Yeah,
we
it's a
just use it as,
misnomer. We know
it's
it's a misnomer.
So you would go after the small business, then go after the mid-sized business. This is the interesting part of like being a business person, is like figuring out threading these needles and making these bets. I think this is some of the most fascinating stuff we get to do.
AJ, so what do you want to do?
Do both, of course, Sam. Take down the world. We're just gonna go do everything.
This seems like an opportunity where GTM efficiency could be helpful or interesting, right? Because it incorporates.
We cohort it. You've got to cohort the data and look at the data separately and see what the data, which we are doing. Like the reality of the situation is like the narrative that I think makes the most sense is like, look, we've actually done ourselves a disservice by not looking at churn correctly. A lot of our customers are actually B2B2C. And in that case, we should pull those out because they should.
What's a good example of B2B2C? Roofers?
RoofCon. I would say that there's
RoofCon should pay us for the amount of exposure they've gotten.
Yeah, so 3 to 5 user accounts that are agencies where they're like 10-9. You're right. It's probably where they're still in these infancy stages of revenue operations or ops in general, and they're like maybe they don't even have a CRM. They're using spreadsheets. They're using Monday.com to build CRMs. So they're not mature in their operations curve. Those would be more B2B2C because they've started more mom and pop places, but they have a sales team. They have people that are door knocking and getting rejections. They need commission tracking, right? So like take those are going to churn at a higher, because those are true SMB versus the technology SaaS platforms that are like, well, we have NetSuite, we have Salesforce, we have HubSpot, like you got to do all these things and we use this platform for payroll or whatever. Their expectation on paying is more mid-market, and therefore they want to find a solutions partner that works well with HubSpot, that works well with QuotaPath. And how do all three of you work well together, but they're willing to pay for it? And so like we just have to cohort that data and make sure from a narrative standpoint, like in the board, and this is frankly like I feel like I'm talking as transparently as I have ever talked on this show. Like this is the area that we're working through and working. Now I feel like Adam Robinson. Here I am building my company on Topline right now with you guys.
But the thing that's giving you consternation is this idea that we're getting all these leads in quote unquote the SMB market. HubSpot sending you agencies. That's who uses HubSpot.
Right.
And Whisper, maybe you want to be acquired by HubSpot. That would be a logical outcome. So maybe we would want to build towards HubSpot's goal. And then meanwhile, but maybe the higher GTM efficiency customers, the higher retention customers, maybe there's higher LTV with mid-market, but we don't have the same track record of generating pipeline there.
Yeah, it's and 100%.
How do you turn away from existing pipeline?
Yeah, and Ryan Milligan, our VP of Ops and Sales, like we are going to a mid-market conference, like to meet with bigger companies, $100 million to $1 billion in revenue, to talk about their 2025 compensation management challenges that they're having. How do they drive the right outcomes? That's the right type of customer, but then we have to be ready for it and resource on our CS team, on our delivery, like the delivery and implementation team, but they're the ones that are dealing with these $2,000 to $5,000 to $10,000 customers, and at 1,000 customers, it's real scale, real challenges, real problems, and I said I wasn't going to use this term again. JR said I use it too much on Topline, but I haven't used it in a while, which is it's fascinating. It truly is a fascinating place to be. So sorry, JR.
It's weird. Someone gave you a few. You can say fascinating as often as you want.
I get lots of feedback over I get lots of great feedback.
Maybe he doesn't need so much feedback. Maybe it's time for you to get some feedback.
AJ gets a lot of feedback.
He gets a lot of feedback.
I get none because everyone knows I don't care. No one
tries. Give JR some feedback.
I have to ask somebody.
Like,
when we went for dinner, I asked AJ. I was like, "Hey, like, what do you think?" Because it's like no one even bothers me. I love it.
I get lots of feedback on a daily.
You've made it clear that you discount. Everybody's probably worried that they don't meet your qualification threshold. That you're going to You're like, you're not a serious person. I don't care about your feedback.
Did I ask you for feedback? Did I ask for this? Please keep it. You want some feedback now?
You are not serious people. I think
this is where one of the things I'm coming to terms with is there are metrics that you want to look at holistically. And I think burn multiples is a really interesting one that gives you an overall idea of capital deployment, which is the number one job of a CEO. So are they doing their job well? And then I think there are these lagging indicators that are better looked at by channel or by segment, because they tell you how a particular strategy is working out. And it's the culmination of these strategies that's your go-to-market team. But like, you actually want to look at strategy by strategy, right? Like, because as we've spoken, if you want to keep growing, you need to make investments and bets. And you over there, you're going to have a very different type of efficiency than in areas where it's your traditional channel that's working well and is mature. And so you should look at it more by channels and by cohorts. Can we talk a little bit about the upcoming rate cut? So it's Tuesday today. Tomorrow is going to be most likely the first rate cut. I would imagine it's 0.25% versus
75 basis points. Here we come.
I think they should cut it 500 basis points.
Negative rates. Let's go negative yield. Negative rates.
Not to zero. It's enough of this.
like flying to zero.
I want to party again. What are the hookers? Let's go.
So I think what's really interesting now is, well, how is this going to affect the market? And, we've spoken about how a lot of the challenge for every business person is predicting the future. And the future is about to change because we're entering a new cycle. So there's two schools of thought right now. So one says rates go down, so the cost of capital goes down, which means driving revenue becomes easier. And the reason it becomes easier is because real world companies finance themselves through debt. And so their interest expenses will decrease, which will give them more funds to allocate in other areas like software. And also when interest rates start dropping, there's a relief valve psychologically where you're no longer you're no longer in an economy that's been cooled down quarter over quarter, but now it's actually going to be improving. So you're like, a little bit more bullish. The counter argument is that we've got rigid procurement processes that have become entrenched. They're not going to flip, right? Companies will stay disciplined. And the second is that we learned a lot of lessons that by buying 15 pieces of technology for one AE, the AE doesn't become better. And actually, the content switching slows them down and makes them annoyed and burns them out. And so companies are going to remember this lesson, that just because I can spend more doesn't mean I need 57 solutions in my overall go-to-market team. So will it become easier or not for most companies ends up being the question. Sam, how do you think about this? What are your thoughts?
I think every company optimizing for its own trajectory is what Adam Smith partially meant by the invisible hand. I think that solving for or trying to change your strategy based on interest rates is a recipe for disaster. I think you will inevitably change your strategy solving for interest rates simply by changing your strategy for what your customers want and how they're reacting, where interest rates are some input somewhere in the atmosphere, but I think you're jumping 12 to 15 steps ahead by trying to solve for the macro as opposed to listening to your customers, listening to your business, and figuring out what the growth trajectory is for your business that's appropriate. And again, that appropriate growth trajectory will tend to correlate. It'll correlate to interest rates.
Yeah.
But starting from the point of interest rates are going lower, what should I do differently? Sounds really, really stupid to me.
Yeah. Because you'll see it in your leading indicators is what you're saying, right? Like your leading indicators.
Yeah, me and AJ we're all having good years for our businesses relative to our plan. So all of us, or at least I am, right? I'm thinking about, okay, how do I inflect the growth curve next year? Now I'm thinking about that not because of the Fed. I'm thinking about that because I'm seeing it in my unit economics. I'm seeing that there's an opportunity to invest, and I don't want to screw it up. I don't want to do what I did in 2022, which is blow all this money and give every department head 5 people just because they ask, and middle managers. What I want to do is make measured investments to inflect the growth curve. But I do want to grow. And am I reacting explicitly to interest rates? No, I am not. So in general, the advice is always going to be run your business as intelligently as you can and try to optimize for what's true. And I think there's no, listening to AJ talk about how hard should they go after mid-market? How, what should they do about this critical partner that they have that's flooding them with leads that is leading to net, to good new ARR acquisition, but might be coming out the back end in a way that is problematic for the long-term health of the business. At the same time, if they drop everything to solve for retention of SMB customers, first of all, that might be an unsolvable problem, or there might be a local minimal or local maximum. Like there's only so far you can get. And then past a certain point, you're on this diminishing curve where every dollar of engineering time and product investment that you spend to solve for retention is less and less redounds to the benefit of the business. And so how do you balance that against like trying to make the appropriate investments in mid-market, knowing that it is way more complicated and you do have to support 1,000 reps? What's the answer to that question? There isn't one. Welcome to why it's hard running and building a company.
But I love how you're talking about this on the inflection point, and you need to look at all of the metrics and just really understand where these inflection points are coming, Sam. But every single hire that's coming into the business, every founder and CEO should be scrutinizing, should be skeptical of like, oh, we need this thing. We have to have headcount to do this. That's like not the world we live in right now. Last year we've had to all go through layoffs. This year we're like, look, let's just hold the ship. We're not going to hire. The Fed cuts the rate. VC, does it get flooded back into the market? Do people raise rounds and all of a sudden our competitors are raising massive rounds again? And we're like, shoot, we've got to spend again. I'd be very skeptical of any organization outside of maybe AI or where you have Blue Ocean that is doing anything like that. You have to be very cautious in terms of the hire has to show their true ROI, and you all as founders, CEOs need to be pushing on your teams to make sure they truly understand the hire. We've talked about our teams in general, like C-levels, not truly understanding P&Ls of the business. And I know Pavilion, Sam, has done a good job to help operators teach this in their curriculum. That's something that still is a struggle I see across startups of all stages. And a Series B startup today is probably still not a Series B startup quite yet. That's still really growing into point. That. And so the executives are still growing into that. So we need to teach our team and help them understand why it's
not just your team. You have to teach your board.
Everyone in your orbit.
Your multiple rounds of funding from venture capitalists that only have experience in ZERP environments that, again, are using benchmarks that are 5 years old at this point and assigning growth expectations to your business that might, where the data, and this is, again, GTM efficiency or whatever, LTV to CAC, whatever your unit, whatever efficiency metrics you're looking at, where the data doesn't support the growth targets that your board is telling you are necessary, and you're not even sure against what criteria they're necessary, because maybe they're just necessary for raising the next funding round or marking up your investment relative to for their LPs. There's all these dynamics that are at play, which makes it really, really hard.
Yeah.
I think it's really important when you're taking money from somebody to understand how their business operates. What are their incentives? So where might I end up in a situation where somebody might be giving me advice that I shouldn't take? Yeah. And they might not even be trying to do it in an evil way, but momentum is momentum. Like maybe the market is putting them under certain pressure, which is going to drive certain behavior. So you need to understand their incentives. So I do think there will be a moment where interest rates go down and the premium on growth versus free cash flow margin will change. And some investors might tell companies try to go after even more growth because that might give the nets round a bigger multiple. And that would look good on their books. And they're sitting in a business where the vintage that they raised in 2019, 2020, 2021 is not going to provide much of a return. So now they need to show better marks to raise more money from the LPs maybe. And that is now a conflict of interest between their interest and yours. There is an argument to make that if you go from 5 million to 25 million in a year, will you be able to raise more money even if your go-to-market metrics don't look great? You probably will. 5xing in a market, you can probably raise. But know that you're playing the highest risk game possible. You're playing roulette at this point, right? Because if you miss, you get a 3x or 2x on that, and your go-to-market metrics look like what they'll, horrendous. That's existential probably now. And so
that's Adam Robinson's point. I think he's writing a post this week talking about debating my point that growth is worth 3 times profit and saying maybe that's true from an enterprise value perspective, but if pushing for growth pushes the company out of your hands and you lose control, then who cares?
I think he speaks about it so absolutely, though. So in his world, I would say, listen, if a company is at $100,000 in revenue and is 50% profitable, should they just stop focusing on growth at that point? I would argue that's not a livable income for most people. So you don't stop, you keep growing. The world is just not as absolute as Adam likes to make it sometimes. Which brings us to a really interesting last topic for today, which is a research note from our friends at Go-to-Market Partners.
GTM Partners. Research note.
The known source for research notes and frameworks in our ecosystem.
Nor playbook.
And playbook.
Guinness Book of World Records for the most frameworks created.
Most frameworks ever published.
FPS, frameworks per second.
That is so true. So they published this research note titled, "It's Time for a Chief Go-to-Market Officer." And so basically, their argument is that this is a role that CEOs should play, but CEOs are too busy managing boards and investors, and the COO and CROs are not appropriate to manage all of go-to-market. COOs are too operational. CROs are typically focused on short-term revenue. And so enter the Chief Go-to-Market Officer, or the CGTMO. I'd love to say that in public. I'm the CGTMO of this company. And this CGTMO is going to be responsible for overseeing key metric indicators like cost of acquisition, NRR, and cost of retention, and will manage and will be responsible for aligning your go-to-market, traditional go-to-market teams with product. And so the question becomes, do you agree with these folks that we need another executive role focused on go-to-market other than the CRO? And can go-to-market handle more costs in the form of a new executive with resources under them? Or is this a bit of a ridiculous suggestion? Sam, how do you feel about this?
I don't know if it's ridiculous. That's a little aggressive, but I don't think we should lower our standards for what we expect from executives because of what AJ just said.
That's a good point.
Should we change the word Series B to Series B? Should we change that stage to Series A plus or A2 so that Series B does? I don't even know if that's a good metaphor. Here's my point. I think the chief revenue officer should be responsible for the go-to-market motion of the business. And if the people that are currently CROs aren't qualified to be CROs based on an expanded definition that holds them accountable to driving efficient revenue growth, then we should train them so that they are. And if all CROs today, or a majority, come from a short-term transactional sales-focused background, then we should change the job description. But I don't think we need a new role. I think we're describing a chief revenue officer. That's just what we're describing.
That's what I was going to say. Key responsibilities of the CGO: live and breathe the customer experience.
GTMO.
Keep GTM teams focused on strategy. Collaborate with CEO and COO, CFO to align GTM with overall organizational goals. I mean, that's a CRO. Am I wrong?
That's the CRO. And listen, we understand that in early stage companies, the CRO sometimes has a CRO title without the CRO mandate. But as we covered before, if you're doing 100 million in revenue or more, you usually have a president of field operations that is essentially managing all of these various arms and legs, and that person does this job. Like I don't know. Like sometimes when I read these things, I did find it ridiculous because I thought, could you add another person in an executive team? Like, have you sat in executive meetings? Do more people make those meetings go better? Do more executives make a company run more efficiently? Like I think we have to realize leaner teams, leaner organizations are better because they can make decisions faster. Alignment becomes easier amongst them. So if you have an 18-person executive team going after a market and another company with a 6-person executive team, just based on those two metrics, I bet on the 6-person executive team. Like I think leaner, meaner exec teams and the same philosophy across the entire org, less managers, more revenue per person, more responsibility per person. Like, I think that is how we need to think about this versus adding another whole new org to now. Like, imagine in ages where the trash of if you've got a president of field operations, you're like, hey, got a new colleague for you, the CGTRO. And it's like, what? Like, you just watered down my mandate? Like, is that going to do you any good where somebody's sitting on top? You now have that conflict there.
Yeah, I do love the word thrash. So I love the word thrash. You're right. But like,
it's a good word. I think it's a good word.
Overcomplication of roles. There's the misunderstanding of existing roles and how this fits in. Like, you're creating complexity. There's not a one size fits all solution that all companies, or regardless of the size, growth, need the role. I mean, I think he does cohort out like 0 to 10 or whatever. The issue, what we're really talking about is getting to the actual dysfunctional issues that exist in go-to-market, and ignoring that misalignment that comes from some of these issues, like a lack of strategy, poor communication, misaligned incentives across departments. Maybe there should be a solution for that. But across the board, that's just it didn't hit. I'm sorry, Sangram. I love your book, Move. It's a great book. I read it when it first came out, but this falls flat for me.
Yeah, same.
3 thumbs down for CGTMO.
That's the maximum number of thumbs down possible.
Gitmo.
Gitmo. Well, that is it then.
How we do? 10 out of 10? Sam, did we do 10 out of 10 this week? Did we
I give you a 10 out of 10, AJ. I give Asad a 10 out of 10. I give myself a 9 out of 10.
9 out of 10. Sam's going to take my my zoo analogy and just run with it. That's what he took from this episode. He's like,
that's good. If you want to get rid of discounting, it's like getting rid of animal shit.
You own a zoo?
In a zoo. It's also like, I don't know how much, is it a 10-20% implication? Isn't that baked in at the front end that companies, the team is going to be discounting? That's baked into a model. Like,
what does
I don't know.
mean? I just don't even know what it means.
I've never seen a large company
discounting
that doesn't
off a price you made up. The whole thing is an elaborate.
Are we thinking the CRO of the CFO of a company like, I don't know, Zscaler? Did they think that we are basing revenue on a 0% discounted model? Like, I don't think that is any person in a publicly traded company sitting and modeling things out and providing estimates to the public markets that
assuming that discounting is free, that meaning like tell them to stop discounting, it won't change my win rate.
Yeah. We need to get Alina from Chili Piper on. They have done a really good job with discounting. She has a pretty stringent rule since the inception of the company. They don't discount,
which is
they don't discount because they were bootstrapped at the beginning, and they literally said they couldn't discount. They'll send you hot sauce though. We always got hot sauce for it. They're like, we're not discounting, but we'll talk to her about it. We should have her on.
It's harder at the enterprise level when you have procurement. When it's mid-market and you're dealing with like somebody where you just need to give them something to say to their boss, so that they can appear like they got some concession in the negotiation. That's different than when you have an entire department who will actually not let the company sign up for the deal if they don't get some kind of concession. And don't care particularly.
$1 million deal and your competitor is giving it for $750 and you stay hard at $1 million, and let's say there's not a heavy differentiation between products, which we've discussed, like there's not much between most top competitors and categories. What are you going to not like discount at all? You might not have to go down to where they went, but are you going to stay up there? I don't know. Like, I think you just model in a certain amount of discounting, use it strategically and in a disciplined way. You don't want to lead with discounts. You don't want to win primarily because of discounts, but it's a strategy. It's a go-to-market strategy that you can use. You can also use it to drive retention. Like, let's say you wanted to hold on to a cohort of customers because you feel that right now, if we keep prices here, we're going to lose these customers. But if we can discount them for a certain period of time, we can build the functionality that will keep them there for the long term. That's a very smart discount that you would offer people. So I think you can be very strategic about discounts. I just think that comment meant that CFOs are not modeling this in. This is modeled in, guys.
Sam, was there any amount of discount that would let you stay at that Airbnb again? I think the answer to that is no, clearly. All right, we got shout outs and wins of the week to get to. Asad, you got one top of mind?
I do. So I am now part of a new private equity company called Prestiza Equity. And so
Is that really how
this
it's
is
pronounced?
I hope so. I hope so. I've taken on an advisor role with them, focused on go-to-market and talent. But the idea here is it's a new PE firm. It's focused on businesses that are doing, right under $1 million in EBITDA to about $5 million in EBITDA in services and in tech. And I'm just fascinated because I've spoken about how at STA, 60% of our clients have become private equity businesses now, or private equity owned businesses. And we really enjoy working with them. I think they're fascinating companies. I like the business models and how they're run. And I just think private equity we discussed how between different asset classes, it's the top performing asset class many years in a I think the top performing of the last 15 years, when you look at it year over year, is private equity. And there's just so much money to be made. And when I look at the next 10, 15 years of my career, at some point, I want to take part in that. I think I've got some skills and capabilities that enable me to be able to do well in that space. And so this is a chance to learn while also impacting. And so I'm really, really excited. And if anyone listening knows of businesses that are looking to sell, where founders looking for a stylish exit and is somewhere in the under $1 million to about $5 million in EBITDA range, give me a call.
I love learning about different asset classes, and your experience with PE always fascinates me. So keep it up. Sam had to drop out for a second, but Sam, we already gave your shout out to Airbnb. You gave 2 thumbs up to Airbnb while you were gone. You just don't know it.
Renaissance. I got a new Airbnb. It's the Renaissance Seaport Hotel. They can go. I hate them.
Weston's hanging in, but this is all through my phone in Boston. So shout out to Boston AT&T cell service. My shout out goes to Kyle Norton. Kyle will be joining Topline in a few weeks and covering for me, but I had a prep call with him yesterday, and he's fantastic. He has a few things to say to Asad about revenue operations, and I can't wait for that. But he also spoke at SaaStr last week. He was on the Legend stage in front of second biggest stage in SaaStr. And of course, Jason Lemkin is on his board at Owner. So he has had some great takeaways from SaaStr that I'm sure he'll share with you all when he joins. So thank you, Asad, or thank you, Kyle, for filling in. Asad introduced me originally to him. Kyle is now a advisor to QuotaPath, a good friend of the pod. So appreciate it.
I'm a customer. I've introduced advisors. I don't even have a pen with QuotaPath written on it.
You want a pen? Okay, I'll get you a pen.
I don't know. A hat, maybe? I can't wear hats, though. My head's too big.
Sam, what you got?
Sam? Can you all hear me okay?
Yeah.
All right, that's good. I don't know. Who am I going to give a shout out to? I'm going to give a shout out to the team at Pavilion, who's putting together an incredible run to GTM 2024. We've got Kim Scott, we've got Benedict Evans, we've got AJ and Asad, we've got all of us. I'm really, really excited. I think we sold 33 tickets yesterday. So I think it's going to sell out now. And I'm really just proud of the progress we've made. We're having a great September, and I hope to see everybody down in Austin in a couple of weeks. It's going to be truly fantastic. Thanks for listening, everybody.
This episode was brought to you by AirCall, the business communications intelligence platform. Deliver a better experience for your customers and your teams at AirCall. That's AIRCALL.io. Save time, save money, and improve performance with a single communications platform.
Thanks for listening to Topline. New episodes come out every Sunday. If you like what you heard today, subscribe so you never miss an episode, leave a 5-star review, and share it with your friends. Don't forget to join our Topline Slack channel to connect with us and discuss the topics we cover with other listeners. Click the link in the show notes. Lastly, if you're interested in joining Pavilion, you can learn more about membership at joinpavilion.com/membership. Thanks again for listening.